yeah, we mentioned yesterday in the in one of our talks that with instances like the coronavirus and natural well, situations that are out of our control, we always have to adapt. And funnily enough, Corona is driving us more towards digitization, right? So here we are, live streaming in Zoom and on YouTube.
Okay, neue Freigabe. So we have it. Okay, just maybe for the new joiners here. Irgendetwas, ja.
Right.
Das ist präsent. Nein, das ist der Dings, der YouTube.
Oh, that's you.
Das ist der YouTube.
Also eben, wo ist die
Ich muss den da, oder?
Ja, dann.
Der da.
All right.
Do you see it now? You have on the screen?
Yes.
Okay, perfect. Just 2 words about what we do here. Normally, we would be in Davos, pretty tired from skiing, coming into a location where we share these talks, and then after this we will go for dinner. Tonight is Friday. We would go in a cheese fondue setup, and the plan was that we do it Texas-style barbecue cheese fondue.
Of course.
David will be able then to share with us how this will look like, just so that you get hungry. That will be in the later stage. Now we go into the first presentation done by Daniel. Daniel is one of our crypto mountaineers, early stage. You're a skier, right?
I'm a snowboarder.
Oh, sorry, you're one of these snowboards.
Just quickly, Tom Leons posted in the chat, it's okay for me if you still invite us all to dinner, Rachel.
Okay.
And of course, we all gladly accept this invitation. Fantastic. So we're all going to meet at 8 o'clock down here in Zurich. It's all on Rachel, trust me.
Okay, great. Just 1 meter distance. So that's a Corona distance. That's why you need longer spoons for the fondue. That's the point. But we manage everything. Okay, it's up to Daniel to give an update about the ICO-STO report done by your function as a partner Strategy Plus at PwC. And just raise your hand when we have to continue with the presentation. We help you on that.
Perfect. So thank you, Reto. Hello, everyone who's dialing in. I'm very happy to do this short update on the ICO-STO landscape globally. As some of you know, we've been doing this report now for the 5th time, twice a year usually, starting in 2017. And this has been the report we shared a few weeks ago, actually also in Davos. So look, if you can move to the next page, Reto. Thanks. So this is the summary, and obviously I'm not really telling you earth-shattering news, right? We've all gone through the crypto winter. I think the global crypto markets have definitely recovered. However, the glorious days of the ICOs definitely over. As they transition more into STOs, right, security token offerings. So this is exactly what this report has been covering. It's not a straightforward report because, as you know, there's a couple of websites covering all sorts of token offerings. We are, for this report, basically looking through all different sources and then manually validating each and every individual ICO-STO. That gives a lot of background work to the team engaged here, Jonas, Raphael, Lucas, myself, and others. So thanks a lot to everyone involved. The situation is really we're in a transitionary phase. The US, Singapore, and Hong Kong and the UK have now really dominated in the last 12 months the field of token offerings. We have expected more to happen on the STO side, but basically what has been discussed on numerous panels in the last 12 months is also still very true. The infrastructure and regulatory frameworks for STOs is simply just not there, right? And at the same time, and that's maybe the last comment here on the summary page, the IEOs, so initial exchange offerings, this is something that, yeah, has caught up, but at the same time seems to be kind of a third form of token or of fundraising, as opposed to ICOs, the classic way, and then the STOs. Reto, if you could go to the next page, this is basically visualizing. Thank you. This is visualizing the development, and you can see since May 2019, it's been super flat on the ICO front, and this includes here STOs as well. So basically, the recovery from the crypto winter was very short, and we're really in a moment where not much is happening on that front. On average, we used to have up to 500-600 million raised month over month, and this has now gone down to less than 100 million per month raised through token offerings. So this is really small volumes. You can also see the averages year on year. I think that's interesting to compare. I mean, 2018 was definitely the strongest year ever, even stronger than 2017, which we all experienced as a big, hype phase with the ICOs. But now in 2019, this has dramatically been reduced. Going to the next page, this is the much discussed always top 15. Just a few new entrants, most notably, of course, Bitfinex with their large 1 billion token raising, and then GCBIB from the United Arab Emirates, I think is the first entrant from the Middle East. But all in all, this table has been so stable like never before. Usually with every report, we had to rejig the entire top 10, top 15, but here, I mean, this has been very stable, which also shows probably the lack of dynamics in the ICO sphere. I'll skip the following pages because this is, of course, a report you can download for free anywhere on the internet. It's on the PwC page, it's on the CVA Crypto Valley Association page, and I'm sure Reto will maybe also make it available somewhere to just download with a click. So skipping the next page, Reto, and then jumping right into probably the topic that we're also going to have a good discussion on the panel that's just going to follow, and something we already discussed in Davos very lively is, of course, the security token offerings, right? I mean, this is something has been around for a while. Everyone is really waiting for this industry to kick off. The facts are, and this will be elaborated on also subsequent pages, most corporate issued security token offerings have been exciting, large, but they're not there yet, what we would call the big wave of STOs. I think the potential here is that this can become a really new way to raise both capital and debt for companies of all sizes, large, small, SMEs, and startups. I think this is really exciting about it, but obviously the regulation is not there yet, and there's only a few countries where these STOs are actually possible to do. There's not much liquidity available. There's not enough venues where you can list STOs, kind of regulatorily approved venues. So there's still a lot to be done on the, let's say, plumbing side, the infrastructure side. What is interesting, I think you've also experienced that in wherever you are and being active in this field, there's a lot of tokenization companies popping up, from very large companies to small companies. Basically, a lot of players are entering the field and saying, yeah, we can help with tokenization, and that's a good thing. So there's a big ecosystem growing around this. So I would say in our assessment in this report, we said this STO industry as an ecosystem is really getting ready to scale up over the coming years, which is, of course, something we are all expecting. On the next page, please, Reto, you can just see that also this halt in about May also was happening in the STO space. So counterintuitively, we had more STOs happening, and these are all proper STOs by the definition of regulatorily approved security token offerings. They have kind of stalled also in May 2019, not too much activity, but this is really the shift now onto a kind of a new level, with more regulatory approvals, better infrastructure, and so on and so forth. The next page shows, in a way, a very impressive overview of some of the larger, if not largest, STOs that happened. by governments, by large banks and companies. But as you can see, it's mainly on the bond side, it's syndicated loans. It's really what you would probably call the very classic things of capital markets that are being tokenized here, but in large volumes. I mean, that's the exciting part here. But of course, we all know, coming from the more also crypto scene, that the real potential lies beyond just issuing debt on tokens. And of course, we also all know that all of these tokenizations and STOs have not been 100% digital, right? Usually there's a dual process where there's also still paperwork being filled out and contracts on top of course, issuing individual tokens and then having them custodied somewhere. So we're still going on a bit of a dual track here, but it's very encouraging to see very big, well-reputed names kind of doing STOs and entering the field here. And the next page is just an overview, and this is not a full and representative list, but we just wanted to highlight how quickly growing in terms also when have these companies been created, how many employees do they have. There is a global ecosystem of companies that are really focusing on infrastructure for tokenizations. I mean, Core Technologies obviously is also one of them here present at this conference, and Consensus and others. So there is really a strong ecosystem globally building. And I think this is the comforting news here. It seems that the US and Switzerland are definitely also at the forefront here, but in many other countries you have tokenization companies as well. We expect that if you talk to companies, it's still 1-2 years out till like the more broader scale will come into STOs. But of course, the rationale behind it, and once this is regulatory approved and you have venues to trade it and secondary trading, I mean, this will definitely kick off. So we're basically all waiting on that. This would be also kind of the conclusion of the article and the study and the things we've been reporting about that. We're going to probably follow this up with a study towards the end of this year, depending on how the STOs run. But I think it's fair to say it has really shifted from the ICO over to really the STO field, and we're all waiting now for more dynamics here. I think I'll pause here, see if there's any questions. I'm not going to go into the initial exchange offerings, which is another variant of an ICO, but I think it's better if we have maybe a few questions, and then Reto, I think it would be good to open up the discussion and go to the next item.
Absolutely. Thank you very much, Daniel. You have had the pleasure to join, I think, St. Moritz. That was in early January, just before the World Economic Forum. And I would like to ask you a little bit. I mean, you have, I think, was the third time there.
Yes.
Did you? I mean, mostly our family office there, etc., strategic investors. Did you see a difference between last year? Can you share some insights you have from there? What was the main topic with regard to tokenization?
Yeah, absolutely. I think that's a really relevant question, because the Crypto Finance Conference in St. Moritz has really established itself as a great smaller conference, similar to CryptoMountain Rocks, where really investors come together, family offices, but also regulators. And the STO topic was this year very dominant. At the same time, the mood was much bolder than it was last year. So the Crypto Finance Conference in its first year, 2017, was influenced by the ICO craze, right? There were a lot of startups running around with white papers, trying just basically to publish and market their ICOs. 2018 was a bit influenced by the crypto winter. It was super cold in St. Moritz, and everyone was a bit gloom and doom, and it wasn't really, I wouldn't say, really bullish atmosphere. This time it was very different, and the most striking statistical fact is that half of the participants in St. Moritz were all new, so they hadn't participated in 17, 18. And that shows, more serious companies, more serious players are entering the field. There was announcements like Brickmark on tokenizing real estate on Bahnhofstrasse, Zurich, was basically a few days before the conference. The other tokenization projects were of course portrayed there. So there was really a strong momentum discussed on stage, present in the room, and I think that was in that sense really a successful also gathering from that point of view.
Yeah, great. Maybe I forgot to introduce you, Christian Spar. He's also moderating here, and he has observed also some questions here. Maybe you can ask this question. Christian is, we are here in the office of
Phoenix
Core Technologies and Phoenix in Technopark Zürich. So you know where we are, and where when we go for dinner tonight, please feel free to join. But as a matter of fact, 1 meter distance,
at least.
We break the rule here.
We were already in quarantine, basically.
Yeah.
So this is our lockdown where we are. We're kind of stuck here, basically, for 14 days. No, apart from that, yeah, I'm reading some of the comments and questions that have been posted in the chat. So Vitos Alman, he wrote, what is your estimate on the total market value of STOs by now?
Well, I mean, everything that's been recorded is on page 6 of the report. These are kind of the key STOs that have been happening. But on top of that, as I said, there are a lot of dual track type of issuances. And that becomes then very, very hard to measure because as long as we do dual track type of securitizations, I don't think we're really there yet. The real STOs will happen when we don't do any paper trail, when we don't basically have the safety net of doing everything also in paper contracts. But I think it's too early for that. It's still going to take at least 2 years for that, and the potential in terms of what is a potential market size, that's of course theoretically huge, right? You could go into capital markets figures, look at equity side, at the bond side, the debt side. But on top of that, as we all know, you can tokenize also illiquid assets, you can tokenize alternative investments, and you can even tokenize things that were before very hard to actually do, like derivatives on future revenues. Startups like Utopia going into music rights. So there's a lot of new opportunities and creativity that invites entrepreneurs and innovators to think about innovative ways of doing tokenizations, right? So I think a forecast is very hard to do, but the past, that's gonna quickly get into completely different numbers. As you can see also on the summary of what has been tokenized by the Bank of China, for example, 2.8 billion. Austrian government 1.4 billion. So these are very large transactions, in state-backed bonds. But obviously, as long as you keep a second paper trail behind it, it's kind of, I would say, rather a pilot, right, in terms of STO.
Okay, maybe a comment from you, David, because you have been also joining this St. Moritz conference, I guess, right?
Yeah, it was a wonderful event, and I would agree with the assessment. It was very bullish this year. And I was curious, Daniel, if there's been any further updates since the conference about the legislation that is being prepared in Switzerland that will finally allow in law the use of DLT or blockchain as a way of recording the true ownership of a security. And I think that's sort of what you're alluding to, is this is the path forward as soon as we have legal and regulatory clarity, as that can be the final instrument that clears the way for what you're talking about, that evolution towards the paperless version.
Right. Okay, cool. Do we have some more questions on that? Then we would step into Jürg Müller's presentation. It gives a very clear understanding from a macroeconomics perspective. Jürg, are you online?
Yeah, I'm here.
Fantastic. Let me check with Christian. Do we have some questions to Daniel?
No, there's no questions in the Q&A at the moment, and the chat has been addressed as well. So I just want to remind everybody, all the viewers, you all have the possibility. You have a button down there in Zoom that says Q&A and chat. So feel free to drop in any comments or questions for the panelists at any time.
Okay, great. Then if Jürg is ready, I guess you are ready. I got to skip my slide deck here and then change to your floor, your slides, etc.
Yep, a second. Is it working?
It looks great.
Awesome. Good. Well, welcome from my side to Davos. It's a great pleasure to be speaking to you. I had this talk already at your CryptoMountain Rocks at WEF. So anybody who was there can now grab a beer and get ready for the panel discussion we had to stop last time. Who wasn't there? I will give a macroeconomist's perspective on stablecoins today. And as a macroeconomist, one is a bit of the odd animal in the room, in this virtual room today, because macroeconomists think differently about finance in general and about the whole crypto space. So what I would like to provide you is with a big picture view on what's going on. And sometimes there might be confusion about terms, about words, and I've experienced that before in the session before where I asked two crypto banks a question where one could see that economists think differently about some concepts. So, but what do I want to present? Here we go. Well, the talk, before I really get started with the three parts, I would give a primer about finance in macroeconomics. And this is really Econ 101 for most of you, it's just a refresher. And then over three parts, I would like to show that what we see in decentralized finance, in DeFi these days, is basically, we can see a lot of parallels in previous developments in finance. So I show first, I will talk about traditional banking, how this evolved and what the role of technology is in the development of the financial architecture. And I will then go on to the first wave of digitization, shadow banking, and in the end, I will talk about the stable coins that have emerged recently. First, a few words about myself. I'm a macroeconomist indeed. I did a PhD on the banking stability and the macroeconomy at ETH. After that, I was an economics editor at Neue Zürcher Zeitung. And now I'm head of research and senior fellow at Avenir Suisse. That's a Swiss-based think tank. It's a foundation funded by more than 160 companies and a few private persons. We do not do commissioned research, but we do research from within the organization. And in my team, we look at markets and infrastructures, and this includes financial infrastructures. As such, we did a working paper last summer on Libra, one type of stablecoin, as we will see later. And this working paper we were able to present to the delegation of Maxine Waters when she visited Switzerland in August. And I was also at the IMF in Washington in December presenting the findings in that paper. So now let me get started. And I start very abstract, as all the macroeconomists think in abstract concepts. So this is, as I said, macro 101. When I look at the economy in general, I see basically two systems. It's two layers. And one layer is the real economy. It's where we move in the world, where we buy coffee, where we get Uber rides, where we buy houses. And on top of that real layer, we have a financial layer. And the financial layer is virtual in nature. It is basically human imagination in its purest forms. It only consists of numbers and figures. Yet it is very important for our decentralized market-based economy to work. Because in the financial layer, prices form that then govern all activity in the real layer. So this is sort of a call to you working in crypto space that you have to proceed cautiously or more responsibly in the design of a new financial architecture, because this design is of utmost importance for the functioning of the real economy as well. These prices, as I said, coordinate all activity in the real economy. Now, let us zoom into the financial layer. Again, when I look at this layer, I see basically abstract concepts. When I look closely, I see an ocean of balance sheets. For me, the financial layer consists only of the balance sheets of companies and the links between those. The financial system is in its essence an accounting system. And now, how these balance sheets are organized in the financial system determines in what financial architecture we are. And how the balance sheets can be organized is determined by technology. So how was the financial architecture organized in the industrial age? What you see on this picture is the accounting room of a bank about 100 years ago. And you see guys standing in front of huge books. These are the accounting books of that bank. Today, it's hard to imagine that the banking book was once upon a time a real physical book. And every financial transaction had to be recorded with paper and pen. So there were technological constraints in doing banking or in managing financial transactions. Now, given these technological constraints, it seems to be intuitive that such a financial architecture emerged. It was a highly centralized financial architecture with the large books, with the large balance sheets in the middle of the system. And there all the financial transactions got pooled. Now, let us zoom into one of these large balance sheets in the middle, because here the topic of stablecoins first pops up. This is the balance sheet of a stylized bank in the economic sense. In the economic sense, a bank is a deposit-taking institution, and banking is the term to describe the creation of money out of credit. That is, the creation of deposits out of loans. And in crypto lingo, in a way, it is the creation of a stable coin. It's the stable coin called a deposit. And a bank does that by combining some liquidity reserves with cash flow generating assets. And on the liability side, it issues these deposits and has an equity buffer. The problem with these stable coins, as we will see time and again, is that they're not particularly stable. And it's something we might see in decentralized finance as well. But let's now stick to the industrial age. What we see here is a banking panic in Germany in about the 1920s. And these bank runs, these banking panics have been seen repeatedly in the last century. And the problem is that the creation of this stable coin called deposit creates liquidity risks. And these liquidity risks materialize when too many people would like to redeem the stable coin, the deposits. And if that happens, the bank becomes illiquid and it fails. And the problem is that these banks are in the middle of the center, in the center of the financial system. So when they collapse, the working of the financial system collapses. And as we've seen in the first slide, this is all important to coordinate all activities in the real activity. So banking panics trigger things like the Great Depression. No wonder people started to think like, how can we do better stable coins? How can we improve on these deposits? So in the 1930s, during the Great Depression, people started to think about new forms of banking. One proposal was narrow banking. This is the stylized balance sheet of a narrow bank. And here you see that the stablecoin deposit is now matched one-to-one on the other side, on the asset side of the balance sheet, with liquidity. Doing so, you don't have these bank-run risks anymore. The narrow bank cannot become illiquid because you have this one-to-one matching. The point is that this narrow banking never really got introduced. Instead, governments decided to follow another approach to make these deposits stable with a carrot and stick approach. On the one hand, they guaranteed the stability of the stablecoins deposits with government guarantees. These are deposit insurance or central bank liquidity access. The problem with these guarantees is that they come at the price of moral hazard. If you own a corporation and you have some of your liabilities guaranteed, you have an incentive to take excessive risks. And the same holds for banks. And regulators knew that, so they started imposing regulations to contain this moral hazard. The regulation tackled the problem on the asset side and on the liability side. We saw liquidity requirements and equity requirements. Those were the stick part of this carrot and stick approach. Now, this carrot and stick approach is sort of an institutional regulatory approach, trying to make those central large balance sheet in the system stable. And for quite some time, it worked decently. But then something happened. The digital revolution started to pick up pace. And with that, things changed quite drastically. It is really that this technological constraint of paper and pen, when that was removed, people could start to devise new designs of banking. And in the beginning, a lot of economists and experts thought, wow, that's a great thing. There was quite an euphoria about the new possibilities. You see here a couple of quotes that date all before the last financial crisis. And you see there are some parallels to people praising decentralized finance these days. Also, in the early 2000s, people thought like these new financial innovations will cut out the intermediary, it will bring more diversification and real tangible benefits for the macroeconomy. So back then, people thought with the help of technology, we can have a market-based finance arising. We can have a better form of architecture, and traditional banking, these centralized balance sheet that creates systemic risk, will eventually vanish. And the problem with that view was that it was focused on the single institution. If you look at the single innovation, you can indeed see the benefits. And that's true for many developments in decentralized finance these days too. But let's go back then what the signature product was. You see here the balance sheet of a mortgage-backed security. And if you only look at this financial innovation, it looks quite great because you transform illiquid loans into tradable securities. So you no longer have this banking involved, but instead you have a financial innovation that creates securities that can be traded on a market. You're on the way to a market-based finance. The problem is that this is not where the story ended. You have to understand the single innovation within context. You have to look at the big picture, and this is the big picture. This is a map of the shadow banking system that was sketched by Potsar in 2010. He was back then working for the New York Fed, now he's at Credit Suisse. And the arrow shows within this map where the mortgage-backed security is. Now, we know today that this web of balance sheets turned out to be rather unstable. And the point is that within this web, banking was performed, this creation of money out of credit. But it was not performed on a single balance sheet, but instead on thousands of balance sheets. The risk, however, were the same. In the end, we saw liquidity crisis emerging in 2008. Now, regulators have seen that, and they realized that there was no market-based finance, but basically shadow banking. Now, what did they do? They tried to expand the perimeter of the regulation to include the new institutions with their old tools. So they expanded their carrot and stick approach. But this approach is doomed to fail because, as we've seen, you only need a balance sheet and then artfully link them to perform banking. New forms of shadow banking will always emerge. But let's not talk about the regulation here. Let's now come to decentralized finance, because while this new regulatory framework was picking up pace in 2008 with Basel III and Dodd-Frank, something else happened. Finance entered a new stage in a way. The second wave of digitization took up pace in 2008 when the old architecture was on the brink of a collapse. And this time, we can see that a decentralized financial architecture might really be possible. So first, we have these new infrastructures. These are these protocols, like the Bitcoin protocol, where the infrastructure itself does not need a balance sheet to intermediate. You can have, in a way, an infrastructure without a legal person involved, without a balance sheet involved. Then you have platforms. Platforms actually emerged before infrastructures. These are the peer-to-peer lending platforms, for example. SOPA was founded in about 2003, so even before the famous white paper by Satoshi Nakamoto. Again, these platforms do not take loans on their own balance sheet, but they just intermediate between two balance sheets. And finally, we have the interfaces. These are the on and off ramps of the new platforms, to the new financial architecture, like wallets and other interfaces. Now, at this point, I would like to quickly have a look at Libra. And I know that in the crypto space, Libra has a bad reputation. And I know too that Libra is a project that only exists on paper, and the white paper is not very concrete at this stage, and it is changing. Nevertheless, I would like to talk quickly about Libra. First, it is a stablecoin, and it brought the concept of stablecoin into the public, into the broader public. And secondly, Libra combines the new architecture with the old one in an artful way. Let's have a look at that. So on the one hand, you have the Libra Reserve. And the Libra Reserve is an old school balance sheet that links the old financial system to this new decentralized financial system. Now, as such, it works together with the authorized resellers as a hinge between the old currencies and the new currency. So this way is like setting Libra up this way ensures that actually Libra has a stable value. The Libra Reserve, as we will see later, is basically just a currency basket. And then on the other side, you have this new decentralized architecture with a new protocol and infrastructure, and also new interfaces for end users. And it's easy to imagine new platforms emerging where you have peer-to-peer loans denominated in Libra. Now, Libra, as said, is just one form of stablecoin, and it's probably not even the most interesting one, but for sure it's one that has gained a lot of attention. So Libra, if you look at the balance sheet, it is a currency basket. So you have on the asset side, you have different positions in different currencies, and on the liability side, you issue the new currency. And because the new currency has its own denomination, you don't run into banking type of risks. You cannot break the buck. You can have a currency crisis, so Libra can lose a lot of its value quickly, but you cannot break the buck, and this is important. And this distinguishes Libra from a banking type of stablecoin. We don't know too much about the balance sheet of Tether, But there are some indication that USDT actually runs a banking type of business model, where some of the assets are invested in higher yielding assets, while only a fraction of the stable coins are held in liquid assets like actual US dollars. And if you have such a balance sheet, if you have such a stable coin, you run into the old banking problem that you run a liquidity risk, and there is the possibility of bank runs and banking panics. And this is probably the reason why quite a few stable coins follow a narrow banking approach, where they have a one-to-one mapping between the coins they issue on-chain and the assets they hold off-chain on the asset side of their balance sheet. Example are Paxos or the crypto franc issued here in Switzerland. If you look at these three types of stablecoins, you see there is always a balance sheet involved, there is a legal entity involved, and as such, there is like a central entity of trust you need. You always link with that balance sheet on-chain and off-chain. This is different with two further stablecoins. One is the over-collateralized stablecoin, for instance, the MakerDAO, the DAI, where everything is on-chain, where you have basically a repo contract on-chain in a smart contract. And it's also true with algorithmic coins that try to achieve stability by coding smart algorithms alone. Now, so these are the 5 stablecoins I would identify at this point of time. And of course, there are a lot of interesting questions involved here. And I'm looking forward to our discussion later with Daniel and David. So before we proceed, let me already ask the 3 most important questions I think there are. First, is there really a case for algorithmic stablecoins? A lot of people think there is not, but as an economist, it's very interesting if there is, because in a way, algorithmic stablecoins are fiat currency in its purest form. And it would be interesting to find out if there is really a case for those. Then, what is important for economists and central banks and macroeconomists working there at the moment is, how do these currency basket stable coins affect the stability in the old financial architecture? But it's also important, how do they affect stability in the new financial architectures? And how do they affect monetary policy of today's central banks? And lastly, the question I think is the most important one and the most interesting one from my point of view is, how is systemic risk being created with these new stablecoins? With the blunt banking stablecoin depicted there, it's sort of obvious that they're bank run type of risks. But how do over-collateralized stablecoins work? And are they maybe already a part of a bigger system, of a shadow banking system, where they only a small piece in a chain where debt is transformed into money like debt? Like this creation, the old creation banking is the creation of money out of credit. Are these new stablecoins already a part of that chain? Yeah, these are some of the questions, and I'm very much looking forward now to discuss those with Daniel and David. Thank you.
Wow, thank you very much, Jürg, for this outline of it gives a very good basis to think about stable coins, etc. I know you had to use the L word.
Sorry about that.
But the L word popped up also in our questions we had. And there's somebody who wants to ask you the question, what is your assessment of the chances of Libra going live and in what final form?
Yeah.
But
And this person is, by the way, Tom Leon. So we can see the names. Okay.
Ah, okay.
Tom Lyons disclosed here. And this is one of the questions, I guess we go into that, but I would like to give now the chance to David. David is very much in the topic because he founded this PegNet, and I would like to give a little bit from a very pragmatic point of view, what is PegNet all about? David, are you here? Is David?
Sounds great.
That sounds great. So I would say now we go into the talk battle situation, meaning that you come up with this PegNet, give a very strong point on that because you prove that stablecoin has a very clear business case. And I would invite you to explain to the audience where you're coming from, why did you launch that, and why do you believe that this will be a big success?
Sure, and I think the question has been put right. Is there a place for, call them algorithmic, call them consensus-based, call them Oracle-based, but this third category of stablecoins beyond collateral-based and reserve-based stablecoins? And I think the answer is yes, because it allows the user a lot of advantages. And so to be clear, PegNet has no foundation, has no company. I'm one of the miners of PegNet, but I did not code the software myself. So credit to the developers around the world that have launched the system. If you go to pegnetmarketcap.com, we can see that the market has already answered the question. Within a few weeks of the launch of PegNet, there are $7 million in value that have been placed in the system. There are tens of millions of dollars being converted every day. And just the other day, it crossed $250 million of conversions inside the PegNet system. So clearly people are finding value in these pure, fully decentralized stablecoins. And what's important about PegNet is that the users are in control. There's no operator, there's no counterparty, there's no other person involved. It's just you and the protocol. And so by using this distributed oracles and this mining system to secure the prices of the top cryptos, the top fiats, gold and silver, users can seamlessly move between these different asset classes, because that's what mostly people use stable coins for, is to hedge risk, right? When you see the price of crypto go down, everybody goes into stable coins. When the prices are going up, they want to be able to quickly move back into crypto positions. This is largely what people use stable coins for today in the crypto markets. And so, you know, what PegNet brings is removing those central points of failure. You know, I think that banking model will fail every time. It's always too tempting to leverage. It's always too tempting to go for the higher yield. And as you eloquently put it in your talk, they're introduced to systematic risk, right? So I would much prefer a system where the user can add their own value, they can create their own token, they don't have to take that external or third-party risk of a counterparty that they hope is holding a full reserve of the assets they expect. So I think this is an important evolution, and I've sort of seen all the way from those early days in 2013 where Tether was created in 2014 on Mastercoin and has evolved, but we haven't gotten sort of the transparency we'd hope for from reserve-based. And so I think now that we have the technology, it's time to move to these Oracle or consensus-based stablecoins. So that's what I would put forth, and happy to debate and talk fight it out.
Yeah, sure. Maybe Jürg, can you skip your presentation? Maybe we can give the opportunity to pop up the website of PegNet. Then we have, maybe you can share this website, David.
Sure.
Not sure if I can do that. Maybe you can share.
Just
You can share your
share.
screen, and maybe you have, or even if you have a presentation, that would be perfect. Then we just have a view on how it looks like real life.
Sure, that sounds great. Let's do that. I'll go ahead and share my screen. And let's go ahead and do that here. And I'll share the window where I've got pegnetmarketcap.com for those that want to follow along. Makes it very easy to see what's going on here. So let me know when my screen starts sharing.
Side note, that's a cool headset. I got the same one at home.
Ah, okay, cool. Can you see the screen now?
Yeah, absolutely.
Excellent.
Fantastic.
Perfect. So this is sort of a visual into what PegNet is doing. And you can see that people have placed $7 million of assets into the network. And the way that that's happened is they've taken crypto, they've bought the PEG token, and they've converted, let's say, into pegged Bitcoin. So you can see here on line number 2 that more than $1 million of pegged Bitcoin have been converted into the system. Also very popular are pegged dollars. After that, pegged factoids and pegged gold. So there's all this variety of pegged assets. And what's happening are these tokens are tracking the real world exchange price of gold, of Bitcoin, of dollars, etc. And so it only costs 1/10 of a penny to convert any amount of value you want from any pegged asset to any pegged asset. So if you become bearish on Bitcoin, you want to convert it all to pegged dollars, you can push a button in your wallet and 1/10 of a penny, you can convert as much value as you want to that other value. And what's happening in the protocol is it's validating, yes, I can prove I have, say, $1,000 of value in pegged Bitcoin, and I'm going to destroy those tokens and create an equal amount of $1,000 worth of pegged dollars. And so that's the balance in the system, is it's tracking the provable value that users have contributed to the network. You can see that people do this fairly often. On line number 2, there's $14 million that have been converted into different pegged assets today, and that the network is at $290 million worth of value that's been converted over the last few months of its operation. You can see that pegged dollars are very popular, more than $6 million in conversions today. And that makes sense because having a stable value on one side of the network, when you make a conversion, you can easily trade into something else and not worry when you come back that the other side of your pair has changed. So it's very interesting that the market has coalesced around pegged dollars as that trading pair, even though they could pick anything in the PegNet. Mostly people are using pegged dollars. So this is a really fascinating system. These prices are updated every 10 minutes as the miners report the new prices for all of the assets. So I'll scroll a little further down and you can see that pegged Ethereum, pegged Ravencoin, Bitcoin Cash, Tezos, et cetera, are all listed in the system. And yeah, it's really fascinating to watch the system grow. There's a number of fiat currencies as well, including really all of the top 20, including the Korean won, even the pound sterling, the Swiss franc, of course, and all the way down to the Hong Kong dollar and Indian rupee, which very interestingly, India is just opening back up to crypto. So this is just a little bit of the taste of how the system works. If you want to get a good idea of the mining that's going on, there's another great website, factoshi.io. And if you go to the PegNet section, you can see that there are a huge number of miners. This represents hundreds of thousands of miners around the world and more than 2 billion hash per second that's securing all these prices. And so this is how you create a truly decentralized oracle. Recently, there was an issue with some DeFi contracts where they were using a centralized oracle and somebody was messing with that oracle, pushing it up and down and effectively giving themselves more value than they were supposed to get in the DeFi contract. So this is very timely. As PegNet has been pushing for months, we have to have decentralized oracles. If you don't have a decentralized oracle, you really have a counterparty. And so this is how PegNet achieves that, is by having these miners all over the world submit the prices for all of the 42 assets in the PegNet system. So I'll stop there and just keep it short, but I find this a very fascinating experiment. Again, you know, there's no company, there's no foundation, there was no token sale, there's no counterparties involved, there's no pre-mine. It's just an open source project and people can freely use it. And we can see that apparently there's real demand for decentralized and mining-based stablecoins in the market.
Thank you very much for this fantastic explanation of your PegNet. I have a question with regard to the all over the world. Is that meaning really all over the world, also continents? I learned from the Bitcoin distribution that all over the world meant mainly in China.
That's a great question. That's a great question, and I think a fair question. It really is pretty well spread over the world. So I funded a developer to build one of the first mining pools, and the users, we've seen hundreds of them flow out from Europe, from North America. There certainly are many miners in Asia. But I wouldn't say that it's dominated by that. Looking at the big mining pools involved in PegNet today, a lot of them are based in Europe. I think actually the largest is based in Germany. And then after that, the other one is based in North America. And then there's many, many smaller miners. What's really unique about PegNet is they picked a mining algorithm called LXR hash, which is not usable for ASICs or GPUs. So it's really mostly CPU miners in the system. So it tends to be lots of small computers can get involved and mine the coins. So it's been great to sort of see that evolve and grow as things have moved forward, because it's allowed anybody to get involved. It really reminds me of the early days of Bitcoin when you could just run it on your home computer. So I think that's very fascinating. As sort of the regulatory complexity of doing a token sol is increased, I think this is sort of one of the natural reactions where people have moved back to the fundamentals of mining and sort of open source communities.
Yeah, that's great. Thank you very much. That is a very good explanation that helps to better understand this distribution. The point is a little bit, I mean, this is a dynamic process, and some things are just evolving in a direction you maybe not want to go for. So the reflex is always, how do you manage, or manage is a very, very good expression, governance issues, so that it remains as it is in this distribution, that it will not change into a dominance that you do not want.
Yeah, absolutely. Well, and I'd encourage people to sort of understand these new systems. Pegnet.org has a lot of the technical information and has links to wallets and all things like that. So it's certainly worth taking a look at that. And beyond that, you know, there's sort of a lot going on in the community, so people can certainly get involved. Most of the discussion is on Discord, and you can just go to pegnet.org/chat, and that will take you to the link for Discord, so you can join the community. And there's thousands of people on there very actively exploring all these options.
Absolutely. Okay, thank you very much. Before we go into this talk battle, are there any questions from the audience directly to understand better PegNet? Maybe just give you a chance. You can, if you have access to, you can just ask question directly, enter the space.
Short question. Like, I'm really sure I'm getting it right. Can you explain, like, these pegged dollars? How does it work? I mean, let's imagine I have a $100 bill. How do I get pegged dollars? How does that work? Maybe a stupid question, but
no, very good question. So simply, the way that people transfer value into the network is all on chain. So that's how you avoid any question of if they provably added the value. So to be on chain, let's say you go to an exchange and you take your Bitcoin or Ether and you trade them for peg. Okay, you had $1,000 of Bitcoin, now you have $1,000 of peg. You deposit that peg into your PegNet wallet, and the wallet recognizes, yeah, here's the value of peg right now, I see it on the market, and you would like to convert into $1,000 of peg dollars, and it's going to burn and destroy those peg dollars, or rather destroy those peg tokens, PEG, and create you an equal amount of peg dollars. So you had $1,000 of value in peg, now you have $1,000 in PUSD. So the system is simply an honest ledger that knows on chain exactly how much value you added to the system, and then allows you to convert into any other equal amount in any other P asset you want. And so because there's no order book, because there's no counterparty, you get really big benefits, like the fact that there's no liquidity limit. If you added $1 million to the system, you don't have to hope that there's somebody else who will trade $1 million worth of assets. You're simply referencing the protocol to show that you're converting that value across different pegged assets. So no liquidity limits, which is a factor that decentralized exchanges have very much suffered from the last few years. So if you think of this as like a form of a DEX, a form of a decentralized exchange, it's one that has no liquidity limit because the user provably can move their value around. The fees are 1/10 of a penny, which is a small fraction of what most exchanges or OTCs typically charge. And also there's no slippage, right? In smaller coins, when you try to buy or sell a lot of them, you will move the price on the market, and you'll often end up spending more in slippage than you would in fees, right? You may move the price 1% up or down trying to buy or sell the amount that you want, because in PegNet there's no counterparty and you're just referencing those public prices. You're not moving the price as a consequence, you're just referencing it. So there's no slippage, there's practically no fees, and there's no liquidity limits in this model. And so you can kind of think of it as a consensus-driven system where people are opting into a certain set of rules. The protocol all recognizes these secured data sources, these miners that are publishing these miners that are publishing these oracles. And so I would say the system at its fundamental is only as secure as the oracles, right? And so far, there's been enough hash power that people have felt comfortable putting $7 million in value in the system. Would I put $1 billion in the system today? No, it's not ready for that. But we're in a virtuous cycle, right? People secured the prices with hash power. People felt comfortable to put some value in. It increased the reward. The miners are rewarded in peg. So it increased the reward for securing the prices. So more miners flooded into the system. I mean, the system has grown 400 times since its launch. So the hash power is massively increased. Okay, now I feel more comfortable to add more value into the system. Nobody's going to be able to manipulate this, right? And that in turn has increased the reward again. And so you get into this virtuous cycle. I remember those early days of Bitcoin when you would have not sent $10 million across Bitcoin because there wasn't that much hardware really securing the network. But now you would think nothing of sending $100 million across the wire because you know there are billions of dollars of hardware securing the network. So the question is, can the system continue to bootstrap and benefit from this virtuous cycle and increase its security and confidence as it grows?
Wow, that's very interesting. But I looked on my watch and I have seen that there is a KYC question coming up, and it just arrived. What about KYC AML compliance in PEC? Is that regulated or is that just a field?
Well, it's an interesting question. Effectively, people are having to go through KYC and AML when they go through the exchanges in order to buy peg. But once they've transferred it into their private wallet, there's no custodian.
Right.
There's no counterparty. I mean, you could look at your own driver's license if you like, but I don't think that there will be a reasonable requirement inside your own wallet. I think it's when you go in and out for the exchanges is the natural place that will happen.
Okay, great. Thank you very much. That is the very specific application with stablecoins. Now we are going back to the discussion. Also back to the situation, what is all about? I mean, there's stable coins. We have learned that is there are 5 types of stable coin, basically from an economic perspective approved, other 5. And how do we start the discussion? I would give the point to Daniel, because you had made a very strong argument against the expression of stable coins. Maybe you can repeat that, Daniel, just to give some meat on the bone.
Hey, Reto. Yeah, I can't remember. I did that actually. Did I?
You did, yeah.
Yeah. Of course I did, and I think it's great. It's a great discussion, especially now after the PEGNet. I think there's probably 2 ways of really creating something stable, right? And one is you take any form of cryptocurrency issued by a central bank, or you go the algorithmic route, you know, that David just alluded to and explained us. These are probably the only 2 that have a chance of remaining stable, right? Because everything else, you know, that we saw before with reserve backed and collateral backed, I mean, it's not really stable, to be frank. You know, one argument was, of course, the price fluctuation. But if you think of risk, I think before we said this is kind of risk-free. There are different type of risks. One risk is the market fluctuating, so the so-called market price risk, which is, of course, when it's pegged to something, it just follows that one. But most importantly, there's a default risk. In the case of any form of stable coin where you keep assets somewhere in a vault, or you basically have physical assets somewhere stored, there is a default risk. That stuff can just disappear into thin air, and your currency is gone. In a case of a central bank issuing any form of central bank issued digital currency or cryptocurrency, as you know, central banks still have the power to just print as much money as they want, and some are taking quite some liberty in doing that, especially recently. But this is basically the system where economists say they can't go broke. And I think equally, if you find an algorithmic way to create a stable coin, you probably have the same kind of power that, you know, this system will never go broke, unless, of course, there's an operational risk to it, which central banks likely have less than algorithmic ones. If there's any fault in the protocol, you know, that thing can go bust. I think we shouldn't really be too positive about, you know, creating a big bold world of stable coins. The moment we will see some of the probably then very popular and big stable coins default, I mean, that will create a big stress. And I'm looking at this from the lens of institutional entrance into this market. They will be very careful to choose which currency or which stable coin they will use for their online transactions. For example, when issuing STOs, you know, they will need a counterparty, they will need a currency to deal in, and likely they will not want to do this forever with fiat. So I think that's going to be a very interesting discussion, and happy to discuss that now in the talk battle. What is it, right?
Do you want to respond to that, David, directly?
Oh, I would say that I agree with the assessment. You know, anytime you have collateral or reserve, you have additional risk, right? All these people putting ETH in a contract, it's vulnerable to the volatility of ETH, right? And you can over collateralize and hope that the volatility doesn't exceed the, you know, over collateralization, but ultimately that's a fundamental risk. So I agree with his assessment. Either these Oracle based or, you know, sort of at the fundamental coming directly from the source are 2 ways to have stability. So I think stablecoin is useful in that context, and maybe we need a different term for these other variations.
Okay.
I love that statement, David. If we were in Davos, I would order now a big Texan steak for you and the Texas fondue evening. Huh?
Just imagine brisket with fondue. I mean, there's a restaurant there. That's an idea.
Smoked bacon, right? I love it.
You have talked about system risk. You have talked about affect monetary policy. I mean, if you look at a broader space, if there is an ecosystem evolving that bypasses the kind of the existing monetary policy, do you think that will be an impact, or what is your imagination on that, Jürg?
So if a stable coin,
if stablecoin really goes like this, other?
Okay, depends like what kind of stablecoin. I mean, I think there will be an effect. I mean, ultimately, if we see a big stablecoin, there will be effects on monetary policy today. I mean, that's the reason why with this Libra, with the L word, that central banks are nervous and they are starting to innovate and that all of the discussion about CBDC, central bank digital currency, picked up pace after this announcement. So I think there will be impacts, but I quickly wanted to come back, just if we can postpone that discussion, because the different kind of risks that Daniel mentioned, I was wondering, like fire sale risks, where do you subsume that? Is that on the market price risk, or do you think that is like a particular risk related to these over-collateralized risk, the risk of fire sales?
Well, if that question is to me, I mean, there's a clear answer here. Any way of price fluctuation, whether it's coming through fire sales, market intervention, loss in trust in anything, what you can see in hyperinflation countries, that's always a market price risk,
okay.
Right? And that's something that I mean, even so-called stable coins can, of course, suddenly become prone to speculation when you have large hedge funds or large institutionals that just want to test the market, and still we can't really short sell many of these assets. Once this will become available as an instrument, I dare say it will become quite messy, right? Because we will see some bets against so-called stable coins played out by hedge funds. That's a game they've been playing for decades. And that's where I come in and say, well, suddenly they won't look that stable anymore. And especially if you hold some reserves against that and the reserves suddenly disappear, or etc. It's going to get messy. So in a way, we're still in a kind of a bit pilot stage where we can try out things. But I love the discussions right here. And you know, the question implied that central banks are worried about it. I think they haven't really thought through the broader macroeconomic impact of central banking policy, because if they look at the amount of money that is out there in cryptocurrencies, if they look what is the amount of money in I mean, we're talking, I don't know, 200-300 billion US dollar. That's not a size or a chunk where any larger central bank would get seriously worried. This will change, of course, if you have larger corporates around the world suddenly moving away from fiat currency and saying, hey, I'm going to do my transactions in, you know, token X or in currency Y, that is a crypto one. Then it will become interesting. On the other hand, I mean, I'm like you, Jürg. I studied economics and have a PhD, but honestly, I'm not so happy looking at, you know, how the last 10 years have gone, or since 2008. I mean, negative interest rates. I didn't learn about that at university, and the ability to really do monetary policy in certain macroeconomic environments seems to be, to me at least, quite limited. But you tell me, you're much closer to that, and you've been following up on latest research, which I haven't, I have to admit.
That's much more of a, not so much a talk battle, but more a talk consensus.
Is it? I'm sorry.
Yeah, here, no, I mean, yeah. I mean, central banking got out of control in 2008. So
that's why I think David's you know, example, it has a lot of merits, because maybe for the first time we have a situation where alternatives can be discussed openly, and actually people listen, and not just people in our community, but yeah, central bankers have become very interested in this in the last 12-18 months, as witnessed in various panels and discussions. This in itself is a huge achievement, because if we're frank and honest, 3-4 years ago, very few central bankers would have even followed, you know, a panel like today, or any discussion around PegNet, right? They would have simply not been interested in looking at these examples.
Well, let's just highlight the fact how far even things like Tether have come. They're doing $50 billion a day in volumes. I mean, that's $18 trillion a year crossing the wire already in the form of these reserve-based stablecoins. So it'll be very interesting as these more advanced versions debut, how quickly they'll get adoption and the type of volumes that we'll see. You know, it's amazing to think that PegNet launched a few months ago and $250 million in conversions have already happened in the system. You know, so it's, yes, I think when we cross some very big numbers, the attention will start to come. But I think that's a good thing, is we should, you know, really recognize that this is mainstream value flowing onto the blockchain. This is the largest public assets in the world all of a sudden on the speed and finality of a blockchain ledger. Like that's what we've wanted. Well, okay, it's here. You know, Tether is doing more volume than Bitcoin on a daily basis, which is amazing to see. And I wouldn't have imagined a few years ago, but that's the reality. So, and I would like to point out, it was interesting to see that Libra, as I think officially now said, that they are going to do country by country denominated Libra. So you're going to have your Libra dollars and your Libra euros and your Libra francs, which is something I said that they were probably going to get pushed into, because that is then no threat whatsoever to the monetary policy, because they're just using the normal currency.
We lost your sound.
For users in high, can you guys hear me now?
Yeah, you're back.
You're back.
Okay.
Say the last sentence.
Yeah, well, I was just saying it's been interesting to see that transition, and the basket would have been very interesting, especially for users in countries with high inflation, right? So we've effectively discovered how far you can push it. If you're a central reserve, you will be using the monetary policy of your sovereign. If you have a fully decentralized system, then I think you have more choice.
The thing with this denomination in the local currency, I think it's also a pragmatic thing. Also, very often, if you think in money, you have an indication of price. Jeans cost like this, etc., and then you have no clue when you say 100 Libra. Okay.
Well, and honestly, I'm extremely happy, because this means that the corporates will offer zero competition to the decentralized systems. They have effectively been pushed out of competing over the really interesting DeFi and fintech innovations here. They have to sit on the sideline, and we can build all these decentralized systems with effectively no competition. It's like, thank you, regulators. So, God bless you. This
as long as they do not understand what you do, I think then it's no problem. But if Maxine Waters, for instance, understands what you really do, then maybe you have it somebody from their side on the table and asking some questions, I guess.
Oh, they can go try to find those miners running software all over the world. I mean, like, good luck. Right?
What are the questions that could be asked you? If you, for instance, Jürg, you have the task from the, I don't know, from authority to explore a bit more about this thing like PegNet. What are the questions you would raise?
Okay, PegNet, I have to admit that I haven't looked into it yet, but I certainly will. It looks like an interesting project. I want to understand it better. I mean, it really depends what sort of stablecoin it is, and then you have to design, like, okay, regulation, that sounds evil even, but in this crypto space, but how to tackle it and how to characterize it. For instance, Tether, when David mentioned that and the volume, like, okay, first we have to take these volumes with caution. There has been a lot of research about blown up volumes by exchanges, but nevertheless, if you have a banking type of model of stablecoin that is denominated in the old currencies, here dollars or Swiss francs. And then this currency is used to exchange goods and services. Then you actually have an effect on the prices. And when you have then a growing money supply, because Tether is a banking, if Tether is a banking kind of stable coin, it has an elastic balance sheet. So it can create money out of that. So it can increase the money supply, and at one point that might become meaningful, and then there will be an effect on price levels. And this is particularly important if there is then a run type of situation where all these Tether coins evaporate, like in a banking panic. And then you might, but for that you really have to have huge volumes and these coins being used for transactions, goods versus money. But in that case, if you have a banking panic on these coins, then you might enter deflationary spiral, what you've seen back in the old days with deposits. Like you enter in these old macro problems with banking. So there you would probably start to design like tools to keep this money creation under control, that it does not explode. And in the event of a crisis, you try to stabilize the money supply. But then you're back in the old regulation problem, and that's a huge mess. And that's what we went into in our book. But that's like a different story.
Right.
I mean, Reto, if I may, I want to add another example, to challenge that. And basically, can you hear me?
Yep.
Yes.
Perfect.
Yep.
So I think Blanca before posed that question on KYC. I mean, just for the sake of the argument, I'm going to create a little case study here, right? Tomorrow I start a new business. I open up Texas barbecue restaurants all over the world. Our specialty are briskets. I make a lot of money with those restaurant chains, but because I'm greedy, I say it's not enough. I'm going to expand my empire across the globe with new businesses. So I start selling drugs. I start human trafficking and so on and so forth. And sooner or later, I suddenly become a big mafia mogul, right? A global one, just for the sake of the argument. And now I'm looking for a very smart way to move money around the world between my different operations, across countries. And I say, oh, I love this PegNet or some other, algorithmic stablecoin type protocol. I love that. Whoa, okay, I got a lot of cash from all my restaurants. It's very easy. I'm just going to throw them at some exchanges, convert by, and suddenly I'm abusing a certain protocol as my personal utility settlement coin. But if my intentions behind are very malicious and basically illegal, sooner or later, some law enforcement, hopefully globally, would follow my tracks, and they will find out I'm using that. And suddenly we have a situation where an empire, this whole thing can be compromised. And I'm sure all the PegNet community will not want to be kind of hijacked by a global malicious criminal organization, so that I would then run in this example. How would you solve that? I don't think there's a proper way out. This is a kind of a challenge that could happen to many different projects. And this is what we saw in the early days of Bitcoin, right?
And criminals found out that a permanent immutable ledger was like the worst possible thing you could use for crime, because you're creating that trail that is there forever. And if we know anything, people are bad at cybersecurity, and the bigger your evil empire grows, the more tracks you're leading by a bunch of noobs that have no idea how to use the technology. PegNet itself is not a privacy coin or built on a privacy coin. It uses the Factom data layer, which is anchored into Bitcoin and Ethereum. So all of this is public information. Certainly it's pseudonymous, and you can keep your wallet private. But yeah, if you do any interactions, it's very easy for the authorities to map that. In fact, I think a lot of enforcement agencies was like, go ahead, go use the blockchain. I don't really think they're worried about that, right? Chain analysis is a thing. They have really sophisticated tools for finding bad actors. And honestly, dollars. Like everybody still uses dollars because nobody tracks dollars, right? I mean, that's why it's all covered in cocaine and things like this, right? So, you know, honestly, I'm not too worried about that. I think, you know, the authorities will have a very easy time of finding bad actors.
Damn, so I have to go back to sell my briskets in the restaurants, huh?
There you go. Got to go back to a good life of brisket.
Right. So the underlying problem here is just the entrance. So what is needed? Of course, there is no name saved anywhere on the blockchain. There's no names and addresses or any personal information anywhere on the Bitcoin blockchain, right? So the mistake you're eventually gonna make in this massive empire is leave a connection there somewhere that one of these addresses on the Bitcoin blockchain belongs to a personal name.
Well,
So,
and everybody uses exchanges to get in and out,
exactly.
and all of them are KYC at this point. So
the other way to do that would be OTC on some anonymous type of OTC. Maybe have your henchmen go around trying to sell Bitcoin for actual cash or trying to buy Bitcoin with actual cash. But other than that, there isn't really a properly 100% anonymous way to get in and out of Bitcoin.
The funny thing is, you know, people bring up this crime thing from time to time, but there are hundreds of billions of dollars flowing through the regular banking system, which has far less tools for tracking. And the banks are constantly getting their hands slapped, billions of dollars in fines for accommodating these huge mafia organizations globally. Like, you know, go fix the trillions of dollars that are already throwing through the financial system by bad actors, but before you go after a system that is fundamentally better at all of that than the existing system. So I think it's off as a red herring, and you know, it's something to think about. But so many of those issues have already been addressed in the community since 2013. I think it's in a good place. I would point out to your illusion earlier that, you know, bad actors in the early days, you know, not only did those dark markets get shut down, but the FBI agents who stole their Bitcoin also got arrested, right? It was equally a bad idea to use it for crime on both sides of the equation. So, yeah.
You're talking about the Silk Road and the imitators of Silk Road, right?
Yeah, and the FBI agents that were involved, eventually they found out they had taken all that Bitcoin. And
they also thought they could get away with it. Oh yeah, I'm just gonna put some of that on this.
Yeah.
So the 1,000 Bitcoins. Oh yeah, we secured all 800 Bitcoins.
Yeah, exactly.
Over here, and all 200 of them are ready for examination, right?
Yeah. It'll be an interesting world, but I think we're moving in a good direction. And honestly, I think it'll bring financial freedom to a lot of people. Yeah. That's the important thing.
Okay, let's have a last try to destroy your argumentation. I mean, it was a good try from Daniel. Maybe it's another somebody else, maybe from a different angle, just to try to. Is there anybody in the room, or are you too much hungry because we were talking about steaks, etc.? And I mean, this is a bit an unfair game in my view. You make people hungry, and then they stop to ask nasty questions, because when you do ask nasty questions, then you make everything longer. Right? But let's give a last chance to the audience. You can. Intercept now. If you have the possibility, you can give me a shout, and then you can ask the question directly. Maybe Tom Lyons, you as a New Yorker, you always have a question, I guess.
Tom Lyons is busy thinking about the next baseball season and how the Yankees will do next year.
The pizza's coming soon, so I mean, maybe we can continue this discussion. Can you hear me?
Yes, we can. Yep. Quality is not so great, but yeah,
because I'm using my hand.
Yeah, but it is every time with these discussions, once we get started, we can continue for hours and hours, right? But yeah. While Tom is fixing, he's plugging in his headphones. Yeah. So you continue this.
Yeah.
Yes.
There you
Yeah,
go.
right, so listen, I don't have any
Last try.
I don't have any big questions on the stablecoin thing because I think we went through it a lot. But just if you want to keep on the, I mean, one thing I've been thinking about and talked about in my presentation is this whole surveillance business. I mean, if we're going to go fully digital, whether it's central bank, whether it's stablecoins, whether it's whatever, you know, what happens to? I mean, what happens to privacy, right? And I think that's, I mean, that's a very big question. And I talked about central bank digital currencies before, but I mean, it seems that, you know, if we're trying to build these, or the original dream of Bitcoin was to build a free and uncensorable financial system, but that doesn't seem possible even if we can build it, right? Because you know, you're actually just leaving all these digital traces of your transactions. So that's, I don't have an answer. I don't really have a question. I just want to, that would be the topic that interests me right now.
Okay, listen, I think we are pretty exhausted after this very good discussion. Thank you very much for this very good discussion we have. Thank you, Jürg, for your layout of the more from an academic point of view. Daniel, for your update about the status of tokenization in Switzerland, and of course, David, to our long distance participants directly from Texas, Austin, I guess, Austin, right? That's right. That's the birth of the very first Bitcoin meetup, right? That's Austin. Yeah, okay. So you have even a tradition there, a historic place, huh?
Absolutely.
Fantastic. And I heard some rumors that you going to moving into Switzerland. Is that true?
It's very true. In fact, I would be there right now if my flights weren't canceled due to this virus. I've had 5 events in a row all be canceled. For some reason, they're not happening. So, you know, we'll carry on, but we'll be there soon enough in person.
Yeah, that's strange, eh? Madame Corona, is it a man or a woman? I'm not sure.
That's all right. I'm glad they're taking it seriously, and you know, I'm sure the world will beat it soon. So
better to err on the side of caution, of course, right?
Okay, so let's close down this CryptoMountain Rocks online session. It's feel very sorry because now it will be the moment for a good piece of meat or cheese or whatever,
any type of apple,
and have a good time. We plan to do in summer something. At least at this year we have something like that, and I hope you can make it and you will be in Switzerland, and then we can show a little bit that also in summer we can do some crazy stuff. Not only talking, but also having fun together. And then, of course, I could imagine that instead of having a fondue, we then really can do a Texas-style barbecue. That would be a fantastic contribution from your side. And thank you very much for joining this call. And yeah, I hope this Corona will leave our planet very soon, so that we can go back to normal and meet like human beings meet, etc. Thank you very much for your contribution. Have fun, have a good evening, and for you a good day. Thank you very much. Bye-bye.
Thanks, everybody. Bye.
Thanks, everyone.
Bye.
And this concludes the CryptoMountain Corona edition. Have a good day, everyone.
Bye-bye. So,